thank you for the opportunity to address the same set of people for the second time in an hour. So maybe I can just get started, and then we can, get going. I think if you look at the, last decade, I think nothing dramatic has actually happened in the kind of buyout market. While there has been some growth in the last few years, buyout is still a very small percentage of the private equity investments in India. It's actually, I don't have the exact data, but having looked at it something recently, it's in the 15 to 20% range, right? That too particularly because we've had a few large transactions in the last year. So if you really look at it from an Indian economy promoter mindset point of view, while there are some marginal changes, I don't think there is any significant shift in willingness to sell good assets or good businesses. If you look at what has contributed to the growth in buyout deals, it's primarily very anecdotal, meaning, an HP want to exit a business in India, some of the private equity stuff that is matured and kind of doing a secondary transaction. These are kind of, strategics kind of exiting and more private equity secondary trades were some of the big drivers for the growth. Having, engaged closely with a lot of the entrepreneurs, my experience is unless and until you have a structurally challenged business or there is a big family dispute that just cannot be resolved, I haven't seen people kind of saying that this company has to go to the next level, I'm not the right owner and manager for this, let somebody else who steps in and take this company to the next level. That is what drives kind of controlled transactions and buyout transactions in other market. I don't think that trend is playing out in India as yet. It may change, but even if it is in pockets. But it's other things that I said, the strategic trades, private equity to private equity secondaries that has kind of added to the volume in the buyout side. But one thing which again I referred to in my previous panel, one of the things that could accelerate is a private equity comes in as a minority investor, and when you're looking for the exit for the private equity, quite often there is talk of promoter also selling enough stakes so that the new buyer gets control, right? Some of those trades have happened. Some of them, and there is a lot more talk to it, but eventually, at least a few situations that we have been involved, the promoter develops cold feet last minute and kind of pulls back. But that could be another kind of way for the buyout activity to accelerate. And one of the last deals that I looked at while I was at Blackstone, we actually came very close to doing a deal, but we said, this is an entrepreneur-driven company and is a professional entrepreneur in a services business. It was a little bit of a small check for us, and considering that the control over the exit was very important, and considering that the check size was small, we kind of preliminarily agreed that we will do this as a control deal. But through the diligence and that this entrepreneur did a lot of reference on our individual deal teams and went through a whole set of activity and then confirmed that he's willing to do. And we did a lot of preliminary diligence and came to some kind of non-binding but serious term sheet. And literally the day on signing, he said, I don't feel comfortable giving control, because in that particular case, he would have been managing the business going forward as well, because one of the reasons that we were investing was he's a great manager, he's probably the best guy to run the company. And he said, I don't feel comfortable selling the business and running the company going forward, and I would like to have control, and he kind of broke away. So the point I'm making is, while people are intellectually kind of looking at these kind of options, when it finally comes to pulling the trigger, it has been a challenge. So let me stop here and then hand over to Anuj.
Thanks, Matthew. I agree with your comments on there needing to be a real reason for a sale from a promoter's mindset, which is usually not in order to take the business to the next level, but driven by stress in the business, family, inheritance issues, et cetera. The interesting thing we're seeing today in India is with all of the debt and over leverage in the system, one change on the promoter side is I think we're noticing businesses families are looking at selling businesses, sometimes non-core businesses and sometimes core businesses, in order to satisfy some of these debts, with the RBI getting tougher on banks and the banks getting tougher on the promoters. But we're also, I think, the other reason we're seeing a bit of an uptick in buyouts more recently, while still a small percentage of overall transactions, is the GPs and the investors are also more willing to do buyouts. I think in 2005 and 2006, in the early days of Indian private equity investing, there was a mindset that one could not run a foreign institutional firm, could not run an Indian company in a way that would be profitable and maybe make sense. And so they needed to, or felt that they needed to rely on the local partner in a very different way than firms feel today. We're seeing a lot more confidence in foreign institutional equity in actually buying businesses and running businesses themselves. And that's, I think, been a big systemic sort of shift in the last few years that we're seeing more firms interested in at least buyouts, including sovereign wealth funds and the such. So I think we are definitely seeing a little bit more interest and a little more uptick. That being said, it's still a very few handful of firms willing to look at buyout transactions in the market and in India. And I think that it'll probably still be some time before there's many more, just because the exposure to operations on the ground and the learning curve with running an Indian business as a foreign institutional investor yourself takes some time. But I do think that considering the current macroeconomic environment, we should see more and more of these companies come to market.
So I think, I obviously agree with a lot of what you guys have said. In our experience, what we've seen is there's a few sets of folks who look for buyouts. There's clearly a reason, as you said, Anuj, rightly. There's stressed firms out there where leverage in the holdco has dramatically crept up, and firms are looking to sell pieces of assets and say, listen, we can deleverage the holdco by essentially selling out a company or two or a business or two. Those are interesting ones from our end, and we've looked at those. I think another one, which obviously we just completed, was the GE Capital buyout. And that was essentially similar thought, a global firm essentially deciding to exit a business, and we could then carve the Indian business out for ourselves. I think the third one, which you guys have mentioned about briefly, that we tend to see is, and this is a change. This is a philosophical change, a cultural change that I can see coming. It is, there are promoters who essentially have succession issues and are willing to say, look, this is essentially something where I'm going to go off into the sunset, but I do want to have this company, this institution that I've built, be run by a set of individuals, a firm that is going to grow it. So I think that's just about coming. That changeover is coming. I grew up in Bombay, and I think I believe if I looked at it 10 years back, or even 15 years back, there was very few buyouts available from private owners. That is changing. There's actually a set of owners now saying, you know what, I do want to monetize, I do want to essentially sell my business to private equity firms. So that's happening. In terms of numbers, look, I was pulling these out. If you take buyouts of size, and let's say $30 million plus, it's just a random number I pulled, 200 crores roughly, if you will. There's only 94 buyouts that have happened from 2005 on. So think about it, that's it. Over the last 11, 12 years, we've had 94 buyouts of size, of some size. And in terms of actual dollars written, $16 billion and below. So we're really talking small numbers. Matthew said this is probably 20%, yeah, roughly, I think it's below, it's about 10, 15, 20% magnitude of the total private equity investments that happen in India. The vast majority in India still ends up being, growth equity minority. But as GPs, and I think we've taken that view ourselves, which is exits are complicated in India. It's great to essentially have a nice markup, but cash on cash exits, which is where LPs are looking for, those have been difficult. I think minority equity tends to be difficult on that end. So with buyouts, one believes one has control, one has the ability to monetize, whether through an IPO, a strategic sale, or any other exit ability possible. Control gives you that. And I think more and more GPs are seeing that. So I think you're going to see that increase happening. As India's economy matures, as we see size coming of Indian companies, again, I feel we are seeing it. It is reflected in our pipeline. Deals of size have gone up. And I used to look at India in early 2000s, $20 million buyout was a large buyout. That's not true anymore. And Anuj has done some really large ones. I think I was just looking at the numbers, you guys are 10% of the buyouts that have happened. That's pretty large and significant. So that's also a trend that's coming through.
Just to add to that, some of the things that has changed over the past even 5 years, financing is something that has changed quite dramatically. I think if you look at 5 years back, the number of banks who can actually lead a fairly large buyout transaction probably used to be 2 or 3 banks. Today, that number is much larger, and I think syndicated loan market for Indian kind of LBO paper is kind of is very attractive, and thankfully I can't even think of a single default. So which is actually, and there is a lot more interest and appetite, and also although things are now changing, if you look at the past few years with the US dollar interest rates being low, while we didn't get the full benefit of it, we could finance transactions on a kind of a fully swapped fixed rate at a fairly attractive levels, particularly compared to the rupee financing, right? Meaning net of the exchange rate. So that is something that has worked well, and and also I think the point you were making, firms in 2005 and 6, for 2 reasons. One, I think, Anuj, the point you made, that was not willing to really take on and run a business because of the whole India management issues. I think firms have got much more comfortable. And more importantly, when you look back at the track record of minority investments versus buyout, I think buyouts do generally significantly better. I think, so if you are kind of, in a strategy session at one of our firms, or the firms being represented here, or similar firms, always the issue has been, the market is not there, so why waste time on it? It has changed from there to, let's do what makes sense for us. Even if you don't do too many deals, if you do only a deal or two deals, that's fine. But our focus has to be buyouts, partly because I think from the previous session we talked about having ability to control the destiny, particularly exit, right? If you have, I think that's, from my point of view, the biggest change, other than the operational stuff that you can do with a company under your control, your ability to call the shots at the right time, at the right place for exit is a big advantage. And a lot of firms are saying that if you have to deploy capital, we need to have that ability. So firms have gone from saying, market is not there, to let's do, what we like. And may not be all the firms, all the private equity firms operating in India, but several of them have identified buyouts as the core focus, right? So I think, and what happens in life generally is, if you search, you find, right? And if you don't, you don't, right? So I think that is also potentially going to drive some of the buyout volumes going forward.
I think one more thought, if I can add, Matthew, and I think you sort of started touching upon it, and I wanted to just talk to Anuj about this also, is look, I think fundamentally, when you do a buyout for private equity firms, we want to have the ability to paradrop a team of professionals who can run a business. If you look at buyouts in the rearview mirror, most of our buyouts have been either in services, financial services, IT, BPO, and some in the manufacturing space. And why? To an extent, yes, it's driven by mindset. In the newer age economy, promoters tend to be happier to sell the business, emotionally okay, letting it go. The older economy folks tend to believe this is something which, my father passed on to me, and it's my job to pass it on to the generation below. But it's also, to an extent, driven by the fact that you don't have teams that can come in, professional teams that can come in and take over the business. The reason I brought that up also is I think you guys at Brookfield, very interesting job of building essentially a lot larger operating teams than any of us have done. You want to talk about that?
Sure. Yeah, so we've, across our portfolio companies, have about 1,000 employees now who run our various businesses. We like to think of them as almost independent businesses that are governed and overseen by Brookfield, but have built the infrastructure of the people and talent, so on their own, they are big Indian businesses. So if I take our real estate company, for example, the management team is about 100 people, and our real estate business is arguably probably the third largest real estate company in India on its own, which means that we have to give it the attention that a promoter would in building that business in that sense. A big change we've seen that might have happened in the last decade that is allowing us to find these people and recruit these people is previously most companies, at least in the sectors we focus on, were traditionally owned and run by promoters. So promoters were shareholders and management. As time went on and professionals have come into management, even at the promoter-held firms, a new kind of talent pool has emerged of professionals who do have the experience and the confidence to come in and run companies for us. So all of our recruits have been generally from the market. Sometimes when we take over these businesses, there are existing employees, but generally the senior management tend to be new recruits, and they're all professionals in the business, not necessarily coming from the promoter company that we're buying from. And we've managed to, so far, thankfully, successfully staff up those teams. They've managed to actually deliver results on the ground as well, and run the businesses pretty well. Another, I think, mind shift change that comes when a private equity investor or foreign institutional investor buys these companies is the thought process towards investing in talent. Many of these original promoter-held firms would have had a different view towards management just because they, as shareholders, were also playing the role of senior management, and the value maybe put on professional management would have been very different. It's changing today completely. You see that happening all the time. But I think, again, as a private equity investor coming in, we're willing to bring in a CEO, bring in the CXO suite of top-tier talent, and compensate for that top-tier talent and link their performance to that business that we want them to run, which is an opportunity they may not have had otherwise in this market until capital like ours came in.
One of the thoughts I had was, you may want to have, we may open this up for questions after maybe a few more comments. Or maybe if you guys are okay with it, maybe that could be.
I'm good. I think it's easier doing questions.
Yeah? So if you have any questions, maybe we can take them.
How dependent are you guys on folks like Alvarez and Marshall and many of the other consulting operating firms that are beginning to come in? Is the talent pool there strong enough, or would you really depend on market, self-incentivized, brought into the company rather than consulting one step out?
So let me take that one for a bit, and then I'm sure you guys want to comment. So Alvarez, we know them well, great guys, and I think you're right. There is we can see it. I've seen more and more of these firms coming through. I think the KPMG team has some folks. I believe EY does. Also PwC and as well as Grant Thornton. So they all seem to be building up this specific skill set, which essentially would sort of start making sense for someone like us. Now, how often have we used them? Look, there's been only that many buyouts of size. So there isn't that much that has happened. Alvarez, specifically, since you mentioned them, have been doing a fair bit of the turnaround stuff. That's really what they've been good at. And I think they have a team of size over here. I think that skill set is going to be relevant, especially in this whole NPA. The bank NPAs are large. I think there's assets and firms of size in there. And when those larger deals do happen, there will definitely be a need for these firms.
Yeah, I would agree. I think Alvarez and Marcel have, particularly, and the consulting groups in particular, have seen this opportunity and built out, have actually been recruiting and purposefully building out teams of real operating professionals. And what I think the real strength is not every transaction moves at the exact speed or the exact pace or the way that you would want it to. And sometimes you end up owning a business, sometimes even prematurely to having it set up the way you want it to run. There's always a sort of 100-day to 180-day period that it is nice to have the option of professionals who can come on as consultants and almost shepherd or help you get through that phase. So I think on a long-term basis, most of us would probably still intend to or want to build self-sustaining sort of businesses that can run with their own management. But a lot of these firms are very helpful, and we've used them in the past as well, in that initial handover phase from buying a company from a promoter-held group and transitioning it to your processes, your systems, and to your own independent ownership.
So let me give you a little bit different perspective. If you look back 10 years back, I think we used to actually hire the big consulting firms as part of diligence, right? So it almost used to be standard. If there is a deal, you first call this firm or that firm, like the way you will call an EY or a KPMG for diligence. I think life has changed a lot at Blackstone over the past several years. One of the things that we have focused on is to identify smaller consulting firms who have really deep experience in, specific verticals or specific companies that we look at. Needless to say, there are certain industries, for example, IT services being one, financial services being the other, probably cement being a third, where the large consulting firms have done real, heavy lifting on operational improvements, and they're really, really good with that. But outside that, I think relying on, any of these larger names is just not very helpful. So one of the things that we have done, I think, Anuj, you alluded to that, part of our output, other than diligencing and getting comfortable with the business, is also to put together a 100-day plan by the consulting firms as, who are this niche consulting firms that we hire as part of the diligence. And then it gets handed over to the management team. And if you are particularly talking about buyouts, we either go in with a CEO or we have a CEO who comes on board pretty soon. And I think that's true of pretty much every one of our buyout transactions. And one of the things that we have done on top of that is what we call a Young Leaders Program, which we started way back in probably 2008, where we started recruiting from the top campuses, not directly, because if you show up as a kind of a, most of the companies that we buy are not the leaders or, they're not name brand companies. So if you show up in the placement season, and which again has its own issues because it happens only once in a year, we found it difficult to attract talent for these companies. So what we started doing was we started focusing on graduates who graduated a year back and got stuck literally in bad jobs for however it played out, and hired them 3 or 4 at a time at a company, and created what we called a young leadership program, working directly with the CEO's office and with the Blackstone deal team and the operating team. So